Mehta, good morning. Thank you for joining us. Let's break this interest rate and the liquidity situation for our viewers. We at TT now believe that when rates come down, liquidity will improve and banks will see expansion in margins. Is it as simple as I'm trying to make it sound, or it's slightly more complicated?
No, so rate cut always has some impact on the entire banking, and it is because the transmission of interest rate cut on credit portfolio is definitely faster than it is on the deposit portfolio because long-term deposit contracted in the past continue to enjoy the same rate of interest at which they were contracted. So the passing on of the lower rate of interest will definitely be easier for this credit portfolio, but for deposit it will take little more time. There is a time lag between the two, and that time lag usually is from 9 months to 1 year. That's the time frame because depending upon the ALM of the each bank, how much of the deposit and the resources they have mobilized for the long term or for the short term. As regards margins, yes, of course, margins will get impacted because of this gap, but the total income may grow up because when the rate interest go down, then the growth in credit, which is already at a high level, may further grow. And the way the India is planning for a multi-trillion economy in the times to come, the capex, which is already going to happen in the area of infrastructure, in the area of manufacturing, and the other allied industries, because whenever there's infrastructure push, it leads to the generation of the credit requirement into the areas of ancillary areas like cement, steel, and other sectors. So that will propel the demand for the credit, and then the net interest margin in terms of percentages may come down, but the net interest margin in absolute terms may go up because of the higher volumes available in the credit. That is already there, and a reduction of this interest rate will definitely impact some of the treasury portfolios of the banking system also, because when the rates go down, then of course their impact is also felt on the treasury valuations.
But before that, do you see liquidity improving? Do you think Reserve Bank of India, before they officially cut rates, they actually could start improving liquidity? Because it is about balancing both the things, right? If you cut rates and liquidity is tight, it does not fulfill the purpose.
So I think liquidity injection has already improved during last one because the government has started making a lot of capital expenditure in the area of infrastructure, and the liquidity which was lower about fortnight back has now improved by 1 lakh crore during this period, and this is really going to provide a convenience for the regulator also to look for the cutting of the rate, because this is what is anticipated. But looking to the US data which is available on employment and the inflation, and the way it is going forward, because the entire world is integrated, we may expect that rate cut may happen, but may not something towards the end of this calendar year and not before that. So till that point, there may be a transit, but something maybe a small rate cut may happen in October also. But that rate cut cycle is will depend upon the lot of other factors also, because crude prices right now is at a good level. But if there is any issues which get escalated at the geopolitical level, then of course that get impacted quickly, and it can another make an impact on our interest rate cycle.
But Mr. Mehta, there is belief in the market that banks with higher fixed loans are going to be a little cushioned in this, changing interest rate environment. Do you believe so?
No, I don't think so, because the proportion of fixed loan in the entire banking system, if you see, is much lower. Majority of the funding of the banking system is floating rate of interest, and especially to the high rated borrower, it is linked to the external benchmark rates, that is the repo rates and all that. So that impact of a fixed loan will not be much because the proportion is quite less. And as regards to the floating interest rate, wherever it linked to the external benchmark rate like repo, then definitely the prices will go down, and there will be some reduction in the interest earnings.
That's quite interesting, a point that you made actually. So, what about asset quality in this slide then? Would you say that the peak of bad asset quality is behind us now?
Yes, of course. If you see the data which is panning out for the last 5 years, 2016 onward, the gross NPAs and net NPA ratios are reducing year on year on a sequential basis. That is showing about three important aspects. One important aspect is the impact of IBC, because insolvency and bankruptcy code has helped us in bringing a lot of discipline into the corporate world, Now people know that they can lose their assets, so at least before asking for additional leverages and additional funding, they think about its repayment capacities, and that has brought some discipline. That has also facilitated them in mobilizing more capital, so the balance sheets are getting stronger. So corporate level delinquencies have definitely come down, and we believe that that will continue in future also, because everyone has learned a lesson in a harder way. So banks have also become more analytical in lending, and the corporates have also become very wiser in borrowing from the banking system. As regards retail portfolios, in retail portfolio, the entire portfolio is diversified into a large of the segments, including agriculture, including MSME, into the various subcomponents of the retail, like mortgage-based loan, housing, loan against properties, and all. So there will be a differential impact, even if there are certain impact in certain area. So some impact was thought about in unsecured segment, but that unsecured segment, the regulator has already given a caution by increasing the risk weight on unsecured loan, and by putting a word and caution and funding to the NBFCs and all that. So that has put a little brake on growth into the unsecured segment. As regards the secured segment, I think there is nothing much to worry. So, to my view, I think the last past legacies of high NPAs is quite behind. But yes, the system and the new underwriting models being developed, and especially the digital underwriting model which are being developed, will further improve the asset qualities, because most of the decisions will be based on the data, and data which will provide a consumer behavior. The defaults can be predicted, the artificial intelligence can be used based on their transaction analysis. So the coming up models in the lending of the banking sector, few banks have already started lending to the unsecured loans, like personal loans, or to a straight through processes, algorithm based decision making process. Similar things are going to get replicated into the other products, and that products will definitely facilitate in improving the asset quality of the banking system. So I hope now we are going to a global standards of reduce NPAs in the banking system, that will reduce the credit cost and improve the quality.
Mr. Mehta, thank you so very much for giving us your side to it and just understanding what the implications are for the banking sector as a whole.
If you like this video, then like, share and subscribe to ET Now.